You've seen it 100 times. The chart is painting a picture-perfect setup. All your indicators are aligned, and the price action is clean. You feel that jolt of confidence, that electric feeling when you just know where the market is going. You place your trade and expect a clean win. But then, nothing. The market hesitates, it chops, then violently rips against you. You're stopped out and left in complete confusion. What just happened? The setup was perfect. This soul-crushing experience isn't random. It's caused by one subtle but critical mistake. In this video, I'm going to show you exactly what that mistake is and how to fix it so you can turn those ideas into profitable trades. Let's be real, there's a special kind of pain that only traders know. The frustration of doing all your homework and still losing money. It feels like the market betrayed you. You followed your rules, you saw the pattern, but your account balance went down anyway. This is the biggest reason traders lose confidence, not in their analysis, but in their ability to actually make money from it. And what happens next? A totally predictable destructive cycle. Self-doubt rushes in. You start questioning every indicator and every level. Was that indicator lagging? Was my level off by a few cents? Is my whole strategy broken? That confusion quickly sours into anger. You feel like the market owes you one, so you dive into the next half-decent pattern you see just to make back what you lost. The psychological trap here is so sneaky. Deep down, we all want to be the hero who calls the exact top or bottom. We want to be early. But the market doesn't pay you for being a psychic, it pays you for disciplined execution. The market has no memory and it doesn't hold grudges. It couldn't care less how right your idea was. All that matters is whether your entry was confirmed, your risk was managed, and your timing was on point. This cycle of seeing a setup, getting your hopes up, and getting chewed up by fakeouts is where trading careers go to die. Traders get destroyed by these fakeouts, and the root cause is almost always the same. It's a fundamental misunderstanding of opportunity. All right, let's get right to it. Here's the single mistake that's sabotaging your trading. You are trading your ideas, not your setups. Read that again. You're acting on market ideas, which are really just theories, and you're confusing them with fully executable setups. So, what's the difference? Oh, it's everything. A trade idea is just an observation, a gut feeling. It's the first spark. It's you thinking, the market looks pretty weak here, I bet it's gonna drop. Or, price is hitting major support, it'll probably bounce. This stock has been on a tear all day. It's just got to keep going higher. These are all fine observations. They're the start of good analysis. But they are not a reason to click the button. A trade idea is just a guess. It's based on anticipation and lacks the market's stamp of approval. Acting on an idea alone is pure gambling. You're just saying, I think this will happen, and throwing money at it without any real evidence. Now, what's a trade setup? It's completely different. A trade setup is an idea that has been confirmed by your specific, non-negotiable rules. It's a concrete plan with defined risk and a statistical edge. A setup isn't a prediction, it's a reaction. It sounds like this. Price reached resistance. Now I'll wait for a bearish engulfing candle on the 5-minute chart to prove it's weak before I short. The market formed a bull flag. If it breaks above with a pop in volume, then I'll go long, with my stop below the flag's low. See the massive difference? The idea is the what if. The setup is the if then. The mistake is entering when it's still just a what if. Think of it this way. A trade idea is like seeing a nice house and thinking, that looks like a great place to live. You'd never buy it on just a vibe. A trade setup is when you've had the inspection, secured the financing, and reviewed the paperwork. Traders do the financial equivalent of vibe buying every day. Getting this distinction is the aha moment that separates struggling traders from the pros. Winning traders might have dozens of ideas, but only act on a few. They know their job isn't to predict the future. It's to wait patiently for the market to show its hand and give them a low-risk entry. This massive error of trading ideas instead of setups is propped up by a few really common myths. They sound logical, which makes them extra dangerous. Myth 1. Identifying a key level is a trade signal. This is the most common trap out there. A trader draws a line and their heart starts pounding. But a level is just a location, the arena where a fight might happen. Entering just because price arrived is like betting on a boxing match before the first punch. Finding a level is part of building your idea, but it's not the green light for a setup. You need to see the market actually react to that level first. Myth 2. Being right on the direction guarantees a win. This one hurts. You called it. You said the market was going down, and sure enough, it did. Yet, you lost money. Why? Because you got in too early. Day trading is a game of precision. If you short too soon, a tiny pop in price will stop you out. You don't get paid for being right. You get paid for executing well. The market can make you look like a genius and a total fool on your P&L in the same day. Myth 3. Getting in early gets you the best price. This myth is pure FOMO. You think if you wait, you'll miss the move and your risk reward will suck. But trying to get the best price by guessing is way more expensive. Why? Because when you guess your entry, your stop loss is also a guess. A pro sees it differently. The best price is the one that comes after the market has confirmed your idea, giving you a logical and defensible spot for your stop. Hey, if you're having some aha moments right now, hit that subscribe button. My goal is to deliver real, actionable advice for traders every single week. Okay, knowing the mistake is one thing. Fixing it takes a real process. You need to build new habits that force discipline into your trading. Step 1. Separate your language. Create an idea log. You need to create a physical or digital divide between your thoughts and your trades. Grab a notebook and label it Trade Idea Log. Write down all your ideas. NASDAQ is slowing down or crude oil double bottom. Label them theories. By labeling them ideas, you mentally classify them as unproven. Then, on a separate page labeled Trade Plans, you only write qualified setups. This creates a deliberate pause that forces you to ask if your idea is ready to become a trade. It stops you from acting on pure impulse. Step 2. Predefine your 4 pillars of confirmation. An idea only becomes a setup when it checks 4 specific boxes. Period. Context. Why this trade right here, right now? Is the overall market trending or just chopping? This is the big picture. Location. What's the specific price zone that matters? A prior day's high? A key moving average? It has to be a precise area on the chart. Trigger. This is the most important one. What is the exact event that signals your entry? It's not price got close. It's a visible, non-negotiable event. It's a 5-minute candle closed above resistance, or a bullish divergence appeared on the RSI. Your trigger is the market's stamp of approval. Risk defined. At what exact price is your idea proven wrong? That's your stop loss, and it must be based on market structure, not a dollar amount. If you can't check off all 4 of these, context, location, trigger, and risk, your idea stays in the log. You do not click that button. Step 3. Focus on the process, not the P&L. Stop trying to make money on every trade and start trying to execute your process perfectly. Judge your day by how disciplined you were. Ask yourself, did I trade my ideas today or did I wait for my setups? Reward yourself for patience. A pro might log 20 ideas for every 1 trade they actually take. Their job is to filter opportunities, not to force them. Separation is key. Step 4. Use the right tools and understand time. Day trading means using intraday charts, like the 1, 5, or 15 minute, to see confirmation triggers. Understand that the market personality changes. A setup that works in the high-volume chaos of the open might fail in the lunch dead zone. Let's make this crystal clear with a classic day trading example, shorting a VWAP rejection. First, let's look at the trade idea. A trader sees a gap down and a rally back to VWAP. The VWAP is acting like a lid. The trader thinks, this rally looks weak. I bet it rejects. Great idea. The impatient trader, blinded by FOMO, shorts the stock the second it touches the VWAP line. They throw a loose stop somewhere above it. The stock pops, hits their stop, and takes them out. Then, sellers finally show up and it craters for the rest of the day, exactly as they predicted. Now, the professional trader has the exact same idea, but their process is night and day. They see price approaching VWAP and they do nothing. They are watching for their predefined trigger. They're looking for proof of weakness. They wait for a pattern, like a bear flag, to form under the VWAP. The moment a candle closes below the low of that flag, that's the trigger. The market has just agreed with their idea. Now they enter short. Their stop is precise, their risk is tiny. They got a slightly worse price than the amateur, but they paid for certainty and a statistical edge. The gap between a losing trader and a profitable one isn't a secret indicator. It's about discipline. It's about shifting from predictor to reactor. Confusing trade ideas with confirmed setups is the wall holding you back. Stop trading your hunches. Stop trying to be the first person into a move. Your ego might take a little hit by waiting for confirmation, but I promise you, your trading account will thank you for it in the long run. Separate your ideas with an idea log, define your 4 pillars for every single trade, and shift your focus to rewarding flawless execution. This one adjustment, the discipline to wait for proof, could be the single most profitable change you make to your trading this year. Now, I want to hear from you. After watching this, what's the biggest aha moment you've had about your own entries? Let me know in the comments below. I read and respond to as many as I can. And if you want to dive even deeper into the psychological traps that sabotage traders, click the video on your screen. Until next time, trade with a plan, not a prediction. Trade smart.